All right, everybody, I'd like to welcome everybody back. We're going to go ahead and get started. Next, we have a wonderful session, legal developments related to pension and 401k plan asset management. I think you will really enjoy this presentation. It's very timely and very important. With that, it is my pleasure to introduce Johnny Wenzel, who is a principal at the Greenville, South Carolina, Charlotte, North Carolina offices of Jackson Lewis PC. His practice focuses on employee benefits, ERISA, and the executive compensation and taxation. He regularly assists clients with designing, drafting benefit plans, advises clients regarding the legal requirements for operating and administration plans. He is also one of our distinguished board members, and it is my pleasure to introduce Johnny.
All right, thank you, Michelle. Can you hear me okay?
We can hear you perfectly. You sound great.
Wonderful. Okay. Well, I dialed in just at the tail end of the prior speaker session and heard him talking about the potential safety of vaccines and possibly the COVID vaccine. And so I hope there was a caveat immediately before I dialed in that conversation did not apply to the COVID vaccine being developed in Russia right now. I think I'll sit that one out. But thanks everybody for sticking around. This is the last seminar or last session of the seminar, and I'm Johnny Wenzel in the Greenville office of Jackson Lewis. I was thinking if we were having this in person, it would probably be late afternoon, early evening, and we would be preparing to head into the happy hour afterward. And that is the carrot on the stick to induce you to stick around through the entire seminar. So unfortunately, in our current state, we can't offer that now, but maybe when we get back together in person at some point, we can do that. In fact, the last seminar I attended before COVID, they mixed the happy hour with the final session. So you actually went out and got your drink, brought it back in. I think the speaker might have had a drink. And everybody enjoyed a cocktail during the last session. So, you know, I doubt that's going on now, but that's a note to self and to the rest of the board if and when we're ever able to get together again and do this in person. But thanks for joining today. We'll talk about the agenda just briefly here. And hopefully I won't be duplicating too much of the information you learned earlier in the week, and if so, maybe we'll do that with a little more focus here. But we're going to talk today about pension and 401k plan asset management. So, you know, the investment duties and litigation and various guidance that's come out from the government. It's actually, despite all of the ordeal with COVID this year, it's been a very active front as far as government guidance. And believe it or not, even litigation has picked up to a degree, and so we have some interesting cases out there. Different from the usual seminar of this nature, I'm not going to focus tremendously on defined contribution plan investment lawsuits and fee lawsuits. And so, you know, we'll address some of those lawsuits, but not particularly those issues. I know everybody on the call has heard that sort of thing many, many times. And of course, the lawsuits are still out there and it's very relevant, but we'll be focusing on some slightly different aspects as far as defined contribution plans are concerned, rather than just the run-of-the-mill imprudent investment litigation and excessive fee litigation. And hopefully we'll offer something a little different in as much as we'll be talking about DB plan litigation today. And I know that's a topic that comes up less and less, but for those of us among the practitioners as well as plan sponsors, it's still very, very relevant and often involves very high dollar amount plans. And so that's what we'll be doing first. And so I'm going to jump right into DB plan litigation. And we'll talk about a pretty significant case in Thole versus U.S. Bank. So it's rare that this sort of case makes it all the way up to the Supreme Court, but we did have one earlier this year, and that was adjudicated in June. and it is a class action lawsuit alleging breaches of fiduciary duties of loyalty and prudence. And so, although we're not going to talk about DC plan fee and investment performance lawsuits, that is precisely what's going on here, but in the DB context. And so it's a little unusual to see, but interesting nonetheless, and has tremendous implications for plan sponsors, investment advisors, and unfortunately for them, for plaintiffs' lawyers. So to jump right in, this is one of those cases that has a most extraordinary fact pattern, and I mean extraordinary in as much as what was alleged could be described as nothing short of egregious. So going all the way back to 2008, back when it looked like the equity markets were incapable of going down, and allocations were very high in equities across the board, but primarily, of course, in defined contribution plans and plans with employer stock. That's where we saw most litigation. In this circumstance, we have a defined benefit plan. And so looking back to 2008, we have a large DB plan, and it was alleged that that plan lost approximately $750 million, and it is alleged that the reason for that loss is the imprudent management of the assets. And so, it's an extraordinary loss. But what makes it even more extraordinary, particularly for those of you on the call who sponsor DB plans or advise DB plans, whether in a legal or investment capacity, is it is alleged that this plan had 100% of assets invested in equities. Now, think about that for a minute. I don't know if I've ever seen that in the defined benefit context, particularly in a defined benefit plan that potentially has billions of dollars and benefits tens of thousands of workers. That's virtually unheard of. And at least as far as allegations go, that's about as egregious of an allegation rather that you can make in terms of defined benefit plan asset management. Nevertheless, alleged 100% of plan assets invested in equities. Moreover, 40% of plan assets were allegedly invested in proprietary mutual funds. So these are funds that were managed by the plan sponsor and paid fees to the plan sponsor, presumably investments that were available for retail sale, but also made available for the plan's participants themselves. And so I think that's where the duty of loyalty comes in, is that you have a proprietary investment where the retirement plan is paying fees essentially back to the fiduciaries and ultimately the named fiduciary and plan sponsor. So very extreme allegations. Looking at those allegations on their face, one might think to themselves, how could a plaintiff possibly lose a case like this? And of course they did. And so what happened? Upon filing of the lawsuit, the plan sponsor made a contribution of, I think it was around $311 million, if I'm not mistaken. So once the suit was filed, the plan sponsor took immediate actions to restore the plan's funded status. And I don't recall what the funding percentage was, but it was enough to essentially get the plan out of hot water as far as the funding rules are concerned, and as a practical matter, put it such that the participants' benefits weren't in jeopardy of not being paid. So the Supreme Court ruled 5-4, and that 5-4 ruling was on political, ideological lines, which is fairly unusual for those of you on the call who follow ERISA litigation at the Supreme Court. It's rare that ERISA suits make it to the Supreme Court, and when they do, they're typically determined by an overwhelming majority, if not a unanimous decision. And so, this is a little bit of a departure as far as the Supreme Court is concerned in ruling, but the court ultimately focused on the nature of a DB plan, and that is that a participant or beneficiary is entitled only to the benefits that they are promised and accrued and vested in under the benefit formula. So I think Thole was receiving somewhere $2,000 to $2,500 a month. There was a second named plaintiff, Smith, who was receiving about $45 or $50 a month. And those were the two lead plaintiffs in the case. And at all times, they received their benefits. The court noted that if they ever failed to receive their benefits, then they would have an individual right to sue, and of course could sue, and in all likelihood would prevail, unless there was, some basis under the plan document for not paying the benefit. In the end, I think this is a huge win for plan sponsors. The court took the position that the plaintiffs, because they were still receiving their pension checks, had no concrete stake in the lawsuit. The court did point to the one party who did have a concrete stake, and that was the plaintiff's lawyers. They had racked up around $31 million in legal fees, and they were the only party who really stood to gain from the lawsuit, and the conservative majority, semi-conservative majority, depending on how you look at it, on the Supreme Court denied them those legal fees. When you take a step back, it's understandable that the Supreme Court wants to shut down this sort of litigation. That there could be a significant waste and drag on the system. But I think it's also important to understand that the DB plan sponsors aren't necessarily operating in a consequence-free environment on account of this case. That, as the court pointed out, the fiduciaries and the plan sponsors are still on the hook to provide funding for the plan, and from a participant perspective, at least a portion of the benefits would have been guaranteed by the PBGC had the plan failed. So as far as the case goes, though, I agree with the rationale that the individual plaintiffs were receiving benefits and thus didn't have a claim. But it leaves me a little uneasy. And even as a defense lawyer here, it leaves me a little uneasy in as much as the court almost puts plaintiffs in the position where they can only sue a DB plan if the mismanagement rises to the level that would cause them not to receive their benefits. And so there's really no proactive way under this lawsuit for a participant to take action against the plan sponsor or fiduciary for alleged mismanagement until the point where the mismanagement or alleged mismanagement has reached the level that the participant's no longer able to receive their monthly pension. So, on the whole, I think for plan sponsors and certainly in the advisory community here, it's good news and good news on the DB front, but it's imperfect in a sense because it does leave participants with few remedies, and there could be situations where there was real mismanagement, or maybe there was real mismanagement that would rise to the level of fiduciary breach in a company that couldn't afford to fund up the plan. And this suit puts plaintiffs in the position that they really can't do much until they're actually not receiving checks. So moving on, there is another line of cases related to defined benefit plans, and this involves actuarial assumptions. And so it's a little less on the asset management side, but it's close enough that it worked its way into the presentation just because it's a big deal these days. There are a lot of lawsuits. They're all working their way through the courts, and it is a very tough situation. And so what the allegations are that pension plans are using decades-old mortality tables. And they allege that those tables violate ERISA themselves because ERISA requires optional forms of benefit to be actuarially equivalent to a single life annuity. And if you're using a very outdated table, then the plaintiffs would say that that's not producing an actuarially equivalent because it's based on old factors. So this is a tough one. It's tough in as much as from the employer, the plan sponsor side. You have fiduciary, or you have tables written into the plan document that the fiduciary is generally required to follow. Of course, there is an exception to the duty to follow the terms of the plan if the terms of the plan violate the law, but thus far we haven't seen that adjudicated. And so you have a fiduciary who has this term written into the plan that they have to follow. The plan's been approved by the IRS. The mortality tables are in the Treasury regulations, and if the sponsor removes the mortality tables or changes them, they could be subject to a lawsuit for violating the anti-cutback rule. That is, the use of a new mortality table could operate to reduce a participant's accrued benefit, and we'll see that actually happen in one of these cases, or was at least enough to convince the court to drop the case. On the plaintiff's side, it's kind of tough too. You know, you're promised a benefit under the plan, and it's supposed to be actuarially equivalent, but they're relying on tables from the 70s or even the 1950s, and clearly that's out of date. Just for fun, I thought to myself, you know, let's consider you're using a 1954 mortality table, and I thought let's take a look and see what medical breakthroughs occurred in the 1950s that might affect mortality that we take for granted now. And just a short list, you know, penicillin was mass-produced, polio vaccines were developed, and back to the previous speaker, they were used and largely eradicated polio. Human kidney transplants, pacemakers, chemotherapy as a cancer treatment, mouth-to-mouth resuscitation. I imagine that affects life expectancy. Linking smoking to lung cancer. And so, you know, you look at it from the plaintiff's perspective, and they're definitely onto something. And then from the court's perspective, you know, they are presented with a question: is it reasonable in 2020 or 2019, when a lot of these cases arose, to use a 1954 mortality table? And, you know, the courts are having a very difficult time saying, yes, that's reasonable. So what we're seeing are a lot of the cases proceed because the courts are having such a difficult time finding it reasonable. I personally tend to think this is more of a settlor issue, and at least one of the cases in a roundabout way kind of came to that conclusion. But, you know, until the law says plans, you need to use current mortality tables because the old ones are no longer providing actuarially equivalent benefits, personally, I think that this doesn't belong in the fiduciary breach category. So looking at the cases, we have Torres v. American Airlines. And here, the district court threw the case out, and the reason why, as I alluded to earlier, was that if they followed what the plaintiffs were asking for, it would have increased benefits for some, but it would have decreased for others. And so they told the plaintiffs, you are not an appropriate representative of this class because what you're asking for is going to damage other class members, and particularly those who are receiving late retirement benefits. They would have actually seen their benefits go down. And the court pointed to the contractual nature of ERISA, that, you know, a lot of ERISA's principles are based on state contract laws and common law contract laws, and the plan document provides for a certain benefit, and the certain benefit is payable in different optional forms that are calculated using a mortality table that was in the regs and then put in the plan. And so ultimately they were able to get that case booted out of court, rather. The next one, Brown v. UPS. Ironically, the lead plaintiff's name was Brown. But we have a lawsuit, Brown suing UPS, and this is another one where the district court threw it out, and unfortunately, they didn't settle the issue, just as Torres didn't settle the issue either, as to whether the mortality tables are reasonable. Here, instead, they found a procedural reason to bounce it out of court, and that was the failure to follow the plan's claims procedures. I thought it was kind of funny. The plaintiff said something along the lines of, you know, it's pointless to follow the claims procedures. We knew they were going to deny it. And I mean, I think that most plaintiffs feel that way, and most claimants feel that way under plans, but, you know, the law is the law, and it requires exhaustion of the claims process. So the court in Brown was able to sidestep the issue of the mortality table and instead booted out of court on account of the failure to exhaust administrative remedies. And so that's a line of cases that I think we're going to see more from. Ultimately, I think the best way to fix that would be either a court to rule on contract principles that what's in the plan is the agreed upon bargain, even if the table may be outdated. Or alternatively, the government could update the tables, update the Treasury regs, provide anti-cutback relief, and allow or plan sponsors rather to amend plans. Doubtful that any of that's going to happen anytime soon. So these cases will continue to meander their way through the courts, and I expect we'll see a good bit more on this. Well, that wraps up the DB analysis, so we'll move on. And the next thing I'd like to talk about is new DOL guidance. And so I think it's been a surprise to most of us in the practitioner community, but we've received a flurry of guidance from the DOL this summer. They've been very busy. And, I think that sort of thing, there's a phenomenon that occurs when the president is of one party and at least one house of Congress is of a different party, and that phenomenon is that laws don't get passed. And of course the Internal Revenue Code of 1986 was a tremendous exception to that. But by and large, what we see when we have divided government like this is governance through regulation and administrative fiat, for lack of a better term. So, the prior administration did it. And I'm sure many administrations before that, and what's going on now is that the current administration is going through and overruling a lot of things that the prior administration did. And so, of course, I guess in a couple months here, there will be a few counties in Florida and Pennsylvania and Wisconsin that'll decide for all of us whether the laws I'm going to tell you about and the rules I'm going to tell you about are going to last for another 4 years, or if, in fact, these proposals will never be carried through to fruition, or to the extent they are, they will be reversed in the near future. So let's start with ESG investing, so environmental, social, and governance. By now, it's a pretty well-established industry. Everybody on the call, I'm sure, is aware with the general principles, and that is, they're investments that are driven by some moral or ethical concerns. And of course, reasonable minds can differ on morals and ethics, but by and large, what we see are investments that avoid certain companies' securities based on what the companies are doing or what they're not doing. And so, carbon-producing manufacturing concerns, for example, are often avoided by these types of funds because of the possible impact on the environment. So, in June, the DOL proposed regulations that will do what they refer to as clarify fiduciary duties related to ESG investments. Under the prior administration, there was a pronouncement that said investment fiduciaries can consider ESG and take ESG considerations into account in making investment decisions, basically as a tiebreaker if all else is equal. And most of us on the call here review periodic investment reports and comparisons all the time, and at least from my personal experience, I find it extremely rare that all else is equal between two different investments, maybe index funds. Be that as it may, the prior administration opened up ESG investing a little bit more, and the current administration is walking that back in a pretty big way. So what this latest rule says is that fiduciaries must focus solely on pecuniary factors when they're making these decisions, cannot sacrifice returns, accept additional risk, or take on higher fees in order to promote social or political ends. And to put it succinctly, you can go save the world, just not in your 401k plan. That as fiduciaries, the focus needs to be solely on pecuniary matters. They make a couple other assessments in the rule too. One of which is that ESG can be considered, and they do keep the tiebreaker rule, although they definitely walk back the guidance surrounding it. So ESG may be taken into account if there are present economic risks. And I think the rule references something like, if a company's engaging in alleged dumping of hazardous toxic waste, something like that, that yes, it's damaging the environment, but it is also damaging potentially the economics of that company and the ability of their securities to return over the long run. So they allow it in there, but in a much more narrow fashion. And then they also go on to require documenting of decisions, and I believe there's also a statement in there about ESG funds typically not being able to serve as the QDIA for a plan. So where does that leave us? On a personal level, I think what they've said here, at least as far as the focus on pecuniary measures, is a better reading of the 1974 statute. That, taking into account really economics only, risk, return, and fees, and leaving it at that, I think is more in line with what the statute intended. You look at things like providing benefits solely for the exclusive benefit of participants and beneficiaries, and that would tend by omission or to lead the reader to believe that other considerations outside of that really shouldn't be taken into account. But all that said, we have a fairly well-established industry here, and there is a tremendous presence in plans of ESG investments, which leaves a number of plans and advisors in a tough situation now. So I believe administratively the comment period is closed, and if I'm not mistaken, these regulations have been among the most commented on regulations in a long time. So there are a lot of voices in a variety of industries that have objected to what's been pronounced here, and it remains to be seen what, if anything, we'll see in terms of a final rule, and it could be different. For now, though, I think it's important to the extent a plan does not have ESG investments, I would proceed with extreme caution in adding them. And those investments really would need to be vetted by a professional and fiduciary investment advisor, and they would need to be funds that would fall into an asset class and be competitive with any other funds within that asset class. So if your long-term, large cap equity growth fund happens to be an ESG fund, but otherwise is just as good as, if not better, than the other large cap equity growth funds, then maybe that's a consideration. And for those plans who have ESG investments, I think the best approach at this point is to go back and make sure that it was documented appropriately, that there is documentation in the files, whether in past committee meetings or maybe in present meetings. Of course, there's an ongoing duty to monitor investments, and so maybe you didn't explain clearly why this fund was head and shoulders above the other large cap value or growth funds when it was initially selected, but that's something that could and probably should be revisited in a current committee meeting, so that there is some documentation on file as to why this was done in the first place. And how it was done in a manner that would satisfy the rules that are put forth here, and that is, that it was selected on the basis of pecuniary factors solely, and then be prepared to share that. At this point, I don't think having ESG as an asset class in an investment policy statement would be a good idea. So you'd be looking at ESG investments that would fall within other asset classes and happen to be good funds. And I can say anecdotally, at least around here and in the Jackson Lewis Employee Benefits Practice Group, we have seen clients approached by the DOL already, really within days of the rule being issued. We've had clients who have been contacted by the DOL and asked to provide information about their decisions. Of course, for large plans, the investment lineup is produced on the 5500, and so this is public information for plaintiff lawyers and for government auditors and everybody. So it'll be fairly easy if somebody were motivated to identify which plans have ESG funds in them. And as I understand it right now, the DOL is just engaging in inquiries. I'm not aware of that turning into any sort of investigation, audit, or any kind of other administrative action, but more or less just a routine inquiry at this point. And so that, the other law firms and other plan sponsors may have had a different experience thus far, but that's the experience our firm has had. And, obviously that's cause for tremendous concern anytime the government does that, but the government does do this periodically. So I remember an initiative some years back where the government was reaching out to plans that invested in employer stock and asking them to provide information and documentation about how, whether the stock was able to be diversified by participants, and if there were any restrictions on that, was the employer contributing employer contributions in the form of stock, and really just gathering information. And at least in my book of business, nothing ever came of it other than filling out a few questionnaires and replying to the government, and that's it. So moving on, let's talk about private equity. Also in June, the DOL issued what they refer to as an information letter, and this is a response to a request from a practitioner on behalf of a client, presumably a client that is working on rolling out a new investment vehicle, some sort of diversified investment vehicle that has an element of private equity investment. And what the DOL said is that ERISA does not prohibit a defined contribution plan from offering what they refer to as diversified investment options with private equity exposure. And so what we saw here was proposed a diversified fund with multi-class assets in an investment vehicle that could be designed as a balanced fund, something that could qualify as a QDIA, but also had an element of private equity. So historically, private equity has been a concern for this kind of investment just because of potentially more liquidity restrictions and also typically higher fees. And I think those concerns remain. And so, as I've discussed this with clients and we've discussed it at committee meetings, typically I don't see a lot of appetite for this, but this is a fledgling industry, at least as far as it's being marketed to defined contribution plans. And so, over the coming years, I expect we'll see more products like this being marketed and have a better sense as to what they look like. It's important to note that the letter does not authorize direct investment by participants and beneficiaries in their accounts, and that makes sense. That there, I think you would certainly fall back on the liquidity and the fee concerns that really don't make this a particularly appropriate investment in a participant-directed defined contribution plan. Let's see. Yeah. So in its opening statements, the DOL noted a variety of things like, how successful the PE industry had been and good returns, and the fact that it had been available to defined benefit plans. And I take a little exception with the reference to DB plans because it really is a completely different animal. In a DB plan, the investment mix is drastically different than a DC plan. DB plans typically have a very important need for liquidity to a certain degree, but the liquidity is typically very predictable. And so DB plans are able to take on less liquid investments, at least to a small extent, if they're otherwise invested in other liquid investments. And then as far as fees concerned too, you have DB plans that invest in a variety of extremely low fee investments, currencies, and that sort of stuff. And so, you would look at the total mix, and maybe a higher fee private equity investment would be offset by some other investment that's very low fee. And I really think that's just comparing apples and oranges to defined contribution plans. So, going forward, it's something to keep an eye on. I would temper the expectations of any clients who are excited about adding this sort of product to their plan. And ultimately, when these products are rolled out, I think you would look at it like you would look at any other balanced fund or any other mutual fund for that matter. And hopefully, the fiduciary investment advisor is looking at a variety of things in the investment as a whole. And so, the PE aspect, whether it's liquidity, fees, returns, would only be one potentially small aspect of an otherwise very large and diversified portfolio, and they would review that just as they would any other portfolio in terms of returns and risk and liquidity and fees. And so that's out there. That was sort of a surprise, but I don't see that materializing into too much in the near term, but something to keep an eye on over the coming years. Moving on to proxy voting. So yet another DOL pronouncement. This is an August proposal, and what they're attempting to do here is clarify fiduciary duties related to proxy voting. The overwhelming theme of the guidance is to focus on the economic impact on the plan. And so over the years, I think that this is an issue that has never been entirely clear for fiduciaries as to what they should be doing when it comes to voting proxies of the various investments in the plan. And so the guidance took in a sense, a very clear direction, which is, and I list here in the bullet points, the DOL thinks that a plan and plan fiduciaries must vote proxies if they believe the issue could have an economic impact on the plan, and must not vote proxies if they don't. And that's a pretty bold statement there, and of course it's very clear in terms of should or should not, and naturally what is unclear is what is an economic impact on the plan. And I think just as a general matter, as far as proxy voting goes, typically investors of all types, whether they're institutional or otherwise, probably fewer institutional but more individual, that proxy voting, people usually vote with their feet, and if it's a poorly managed fund or poorly managed company, that the voting, I mean, yes, it may be conducted through proxies, but a lot of times it's conducted by selling the security. And so, I think there's a recognition of that underlying issue, which is that if there's really a problem with this investment, you query whether it's prudent to hold it in the first place. Back to the economic impact, though, the guidance does specify that it is the department's opinion that plan sponsors should refrain from expenditures of plan resources on proxy voting research. And so, to the extent there are industries cropped up to deal with that sort of issue, that's going to require a second look. And then they also discuss a process for documenting it. And so ultimately, should this rule come to fruition as proposed, or at least in a similar fashion, I think that plans are going to need to take a look at what proxy voting process or procedure there is in place, if any. And if not, probably have to create one. And so the guidance paid some lip service to that, in that a proxy voting procedure could take into account a number of things, and probably the most important is what percentage of the security does the plan hold. If this is a plan and it holds a very tiny fraction of 1% of the equity interest in whatever security we're talking about here, is it really going to have an economic impact? Is the plan going to have an economic impact on the decision? And so, is it really material that they vote at all? And I believe the regs even mention something along the lines of putting a threshold in there. So if the plan owns a certain percentage or more of the equity interest in whatever security they're looking to vote, then they would vote. And if they own less, then they would not vote. I want to say 5% might have been floated around there, which is typically considered a large enough percent to influence the activities of a publicly traded company. And then also the guidance focused a little bit on what was being voted on. Are you spending time and plan resources to vote in the slate of management that's going to get voted in anyway? Or are you voting on something more significant like a merger or an acquisition? And with the latter being something that may have more of an economic impact, on the plan because it would have an economic impact ultimately on the underlying security. So that was a little surprise from the government too, and certainly something to consider if this proposal should come to fruition as a final rule. So moving on, one last piece of guidance from the DOL. And I will talk briefly about the fiduciary rule. Now, from the plan sponsor perspective, it is important to understand ERISA's definition of an investment fiduciary, but as a practical matter, the prior rule and the current rule don't change much of the day-to-day operations of most large defined contribution plans that are already employing a 321 investment advisor. So I'm not going to focus tremendously on the rule, but there is one aspect, and that's rollover advice, which I think is very important for plan sponsors and important for practitioners and record keepers as well. So looking back historically, the statute was passed in 1974. Fiduciary definition regulation was passed in 75, and there's a 5-factor test, which we don't need to go into. But it remained largely unchanged until 2016, and this was right at the end of the prior administration, and they overhauled the fiduciary rule, included new prohibited transaction exemptions, and did a handful of other things, one of which was extending a lot of ERISA's requirements and protections to IRAs, which I always took a little exception with at the time. I think the E for employer or employee rather in ERISA and the I for individual and IRA are sort of mutually exclusive. But be that as it may, there was an effort to extend a lot of ERISA to the management of IRAs. And that was struck down by the Fifth Circuit Court of Appeals in 2018. And presumably, after striking that rule, the 1975 rule would have applied by default. But the current rule verifies that. And so we have a proposal here in June of 2020, and it reaffirms the applicability of the 1975 rule, but also includes a few changes. And I won't go into all the changes, but the one here that I mentioned, again, very important particularly on the defined contribution plan side, is the rollover advice rule. And so this is something that was added in 2016. The court struck it down in 2018, but the 2020 rule revived it. So it brought it back, and they mentioned in both the prior and the current iterations of this rule that providing advice on whether to take a rollover is or could be construed as fiduciary investment advice. And I think that it makes sense, first of all. You're not necessarily advising on whether to choose between 2 mutual funds or 2 stocks or whatever, but in some cases you'd be advising to choose between cash and continued investments, or investments under the plan that they're currently in with a certain universe of investments available versus an IRA, which may have a larger universe of investments. And ultimately, where a departing employee and participant decides to move that money, if anywhere, could have a very large impact on what they're able to invest in and ultimately what their returns are. And so I think the takeaway here for practitioners and the takeaway for plan sponsors is to be very careful about offering rollover advice. That you want to make sure, to the extent you have employees calling whoever in benefits and asking for advice, that the folks in benefits aren't telling them, look, you really ought to keep that money in the plan instead of taking it out to buy a fishing boat or pay off your credit cards or whatever, or roll it over. On the one hand, I mean that's on the plan sponsor side, and then on the record keeper side, to the extent the record keeper and their call center is advising people on whether or not to roll over or keep their money in the plan or take it out as a cash distribution, I think potentially could be fiduciary investment advice that at a minimum would need to be addressed in the contract. So in the service agreement, we would need to see an acceptance of fiduciary status by the record keeper. But moreover, I think it'd be best really for all parties just to know exactly what's going on. So I've gone so far as to work with clients to look over record keeper call center talking points, review random samples of phone calls, and so we get an idea as to what's being said and whether or not fiduciary investment advice is being provided. And I think as a fiduciary, knowing what's going on is the most important first step in any analysis. And so I think that does it for that one. But that's definitely something to be aware of, and something that both practitioners, record keepers, and plan sponsors need to understand is out there. It's an issue, it's a potential liability, and it's something that merits a little bit of attention. So in the closing minutes here, we'll talk a little bit about DC plan litigation. And as I mentioned earlier at the outset, we're going to avoid the typical investment mismanagement and excessive fee litigation, and talk about a couple of other things. And so first of all, we'll get into employer stock-in plans. And so this is what's referred to as stock drop litigation. That is, the plan is invested in employer securities. There is an event of some sort that causes the price of the employer security to drop, and thereby resulting in losses to the plan. And so, the typical line of cases involves fiduciaries going back after the fact and saying, what was it that the fiduciary could have and should have done to mitigate the losses to the plan? So typically, you see a couple of things recommended. One, disclosing the problem at a corporate level. That is, the fiduciaries, who are often insiders, knew that this problem may be lingering at the company, and that at some point the stock, which may be continuing to increase, is merely a bubble that will be burst whenever this information becomes public, and thus causing a large loss to the plan. Another action the plan could take would be to restrict investment in that security in the plan, whether it's to do it on a go-forward basis, that is, restricting new contributions, maybe to a certain percentage, maybe to zero, depending on what the fiduciary believes at the time is prudent, and could even apply to existing investments. So that is, participants' account balances that may be in that stock fund are being alleged to have been imprudently left there, and possibly the fiduciaries could have taken an action to stop that. So. And that's been going on for a while. Of course, 2008 produced plenty of that. And the Supreme Court finally said enough is enough in 2014 and held in favor of fiduciaries. And they set what has been referred to and can be accurately described as an almost impossibly high pleading standard for plaintiffs. So plaintiff has to allege a couple of things. One, that the alternative action fiduciaries could have taken is consistent with securities laws. And so that specifically gets to the issue of whether the company insiders could disclose the existence of a problem that has thus far not been disclosed. And would disclosure violate securities laws? And then the second thing, and this is the real kicker, is that a prudent fiduciary, and I'll just read what I have here in the bullet point, a prudent fiduciary could not have viewed the alternative action is more likely to harm the stock fund than help it. And so it is a very, very high standard for plaintiffs, that it would have to be a situation so obvious that no fiduciary could have possibly believed that disclosure would be doing more harm than keeping the fund in the plan. Several years went by. Fiduciaries won in nearly every suit, and plaintiffs' lawyers were looking for a way to get around it. And some courts, I think we're looking for it too. And so you fast forward to the Second Circuit Court of Appeals in 2018, and they held in a case against IBM that disclosure was inevitable. That even through the regular securities law disclosure process, information about the failing business division at IBM that ultimately caused the drop in the stock was going to be made public, and so the fiduciary should have acted earlier. Again, in a rare non-unanimous Supreme Court decision on ERISA, I believe it was 7-2, the court vacated the decision, and basically they did it on procedural grounds. And so the court didn't address the merits, and instead they said, look, you know, plaintiffs, defendants, you're both raising arguments that you didn't raise at either of the lower court levels, and so you have to go back and litigate that first. And so Jander has been punted all the way down to the district court, and basically they have to start over. But you know, it's important takeaways are that they vacated the ruling. They didn't overrule it. They didn't say it was wrong. They just vacated it, which means it didn't exist. And so Jander and the others will get another bite at the apple, but that'll take a while to work its way back up. And so post Jander, you know, we've seen a number of suits in the past 2 years, and not all of them, but by and large, the lawsuits are tending to follow Dudenhofer. And so I have a couple here that I've sampled. One, you know, just a comforting statement in a Phillips 66 case that says that the court says ERISA does not prohibit plans from offering single stock funds. And, you know, in holding for the fiduciaries there, they pointed out that was a single fund that was available in an otherwise diversified universe of funds. Participants were routinely receiving diversification notices, and otherwise, you know, the losses the participants incurred were really their fault, more so than the fault of the fiduciary by offering that single stock investment. And then we go to Wells Fargo. Kind of like U.S. Bank, the allegations here are pretty extreme. This is one of those cases where you look at the fact pattern and you think, geez, you know, if the plaintiffs can't win this, they can't win anything. You know, and so what we have with Wells Fargo, this is the unauthorized account scandal that blew up in 2016. It's been going on for more than a decade. And at some point in 2016, Wells had to pay a penalty of around $185 million, and over the course of a week or so, the stock lost about $18 billion in value. And you know, here it's one of those where, despite egregious fact allegations, the court applied the impossibly high standard in Dudenhofer, and the fiduciaries won. And you know, my takeaway is, I think the courts are trying to say that ERISA just isn't the forum for this type of claim. You know, this is a securities law claim. If you've got a stock that's crashing because insiders are remaining quiet over company information, that we the courts really don't think this is something that should be litigated under ERISA. Find another statute to sue under, and I think it's right. I mean, I think, you know, what the courts have pointed out, and what I believe to be true as well, is that this line of cases to proceed, the plaintiffs really have to apply precisely the type of 20/20 hindsight that the statute was designed to prevent. And so, you know, thus far, the news has been good for fiduciaries with employer stock in their plans, but you know, understand that you know, the Second Circuit is apparently predisposed to finding a loophole in Dudenhofer, and so that IBM case is going to work its way back up at some point. Finally, one last slide. We'll talk about participant data litigation. And so here, this is an add-on to the otherwise fairly routine nowadays DC plan class action litigation alleging mismanagement of funds and imprudent investments and high fees. So they, in addition to that, you know, they're including duty of loyalty and duty of prudence claims related to the use of participant data. Specifically, what we're talking about here is a focus on what the record keeper is doing with the data they have on the plan's participants, and are they cross-selling. So we had a settlement in the Vanderbilt case last year, and Vanderbilt's a 403B, but as far as ERISA is concerned, most of the issues related to 403Bs and 401Ks are very similar, although a case against NYU recently did highlight some of the differences and said that that at least that court didn't believe a nonprofit 403B should be held to the same standards as a 401K in the corporate world. Be that as it may, most of the ERISA arguments are the same. And so, there was a settlement about $14.5 million or so paid in settlement, and only ERISA lawyers and those types would care about something other than what was paid in the settlement. But here it was interesting though that there were non-monetary terms in the settlement agreement. And so one of them, and the one that bears repeating on this call and is relevant to the viewership here, is that one of the terms required Vanderbilt to contractually prohibit the record keeper from cross-selling to plan participants. And so this is something to consider, certainly on the record keeper side. On the plan sponsor side, certainly something to consider in reviewing contracts. Much like the rollover advice, I've worked with clients to go so far as to look at the record keeper's various procedures, talking points, listen to some calls, and see what is out there that's being sold, if anything, to plan participants that's unrelated to the plan, and what can we do to stop this from happening. And so I think as advisors and possibly as plan sponsors that's something that we all need to keep an eye on. There's a question as to whether the data is actually a plan asset. And I think the courts will be looking to ordinary property laws, and I suppose that could go either way too. And so that remains to be seen as to how that's going to shake out. But I think for the foreseeable future, when we see lawsuits alleging imprudent investments and unreasonably high fees, I think we can expect a thorough examination of what services, if any, the record keeper is marketing or selling to participants that are unrelated to the plan. And so as plan sponsors, fiduciaries, and advisors, I think it's important for us to all work together to get ahead of that issue. And so in the last bullet there, that was an allegation in the Shell case where the plaintiffs are alleging that Fidelity had a variety of non-plan products available to participants, as well as a tremendous portion, apparently, or allegedly, of the investment lineup was consisted of proprietary funds of Fidelity. And so, that'll work its way through the courts, but in our community here, it's something to keep an eye of, be sensitive to, and try to plan around as best we can. And so, with that, I think I have gone 59 minutes by my count, and I will stop.
Thank you so much. If anybody has any questions, please feel free to raise your hand, use the Q&A, or use the chat feature. And I'll give you all a few more minutes to kind of look that over. And Johnny, this is just an opinion question. Which of these cases gives you the most anxiety or heartburn, especially in consideration with the upcoming potential elections and the impact that those elections could have on them?
Well, I guess heartburn is in the eye of the beholder. And so the one that I see as the most problematic, actually, among these, I think, is the lawsuits over actuarial assumptions. And I don't know that that's necessarily going to be impacted by the election, only in as much as it may have an impact on the future makeup of the court system and ultimately the Supreme Court. But that's one where, really participants and plan sponsors are in a catch-22. That there is no good way to reconcile ERISA with the tax code and the existing plan provisions. Okay. Well, right now I do not show any questions, and I have our time as 11:06, so perfect timing.
And as it is Friday, I just want everybody to also know that I did take very great notes on this, especially at the beginning. And I think our next Friday meeting